Now we are going to do the working capital management, which is a bit more easier to understand, and it's you can relate with your daily life. So working capital is the capital that you need in terms of running the day-to-day operations, right? So what are the forms? If you look at the balance sheet, where you will find this working capital, it will be divided into the main components of cash that you hold, right? The inventory that you have, the stock of the goods, consumables, printing and stationery, the small spare parts, equipments that you need in day-to-day operation of your business, that is called the working capital. Plus your receivables, what you may have sale, and you may have to collect, but your customer have not paid you, so you may have to give them credit that, and you have to collect later. So that becomes part of your working capital, because that's the money you need to run the business, to give the credit to your customers, right? And payables, some of them is not always that customers are not paying you, you are also not, you're paying your suppliers, right? So that is minus from the total. So here you need to keep an additional investment from your total investment, initial investment on into the business, where you may set up a plant, you buy the equipment, you buy the building and everything else. After that, what? You still need some more money to keep on investing. That's a cost of doing the business, for paying the day-to-day expenses before you even are able to sell to the customer, before you are able to even produce anything. So you have a daily expense, right? You have rentals, you have electricity expense, you have telephone expense, you have traveling expense, you have salary expense at the end of the month, for which you need to keep the cash always. So the criteria of managing this working capital would be to understand how you are going to determine the cash requirements for your business in order to keep it. Then you need to buy some inventory to use in the store as a printing, as a consumable, as a tea, coffee, as cost of sales, production, raw material, sometime even finished goods. You have to finish the goods, and then you have to wait for the customers to come and buy from you, right? So you have that, again, another investment into the business, which is not a fixed furniture or not a fixed equipment. Then you, as I explained, you have credit sale. You even though you have made a sale, the customer may not have paid you immediately, they may take some time to pay. So again, there is a investment into the business which comes into receivable. Even though you are not paying out of your pocket on receivables, but it still is an investment. If you, it's an opportunity, so you could have received this money in cash which you are not receiving now, so that basically is also equivalent to a payment, just like inventory or cash. And payables are the opposite of it, so it's helping you with your finances. Some of the companies, they run their day-to-day operations with the finances from suppliers, so they are also not paying to their suppliers, so they net off everything, so that their additional investment is not there. The more money you are going to invest in your net working capital, the lower will be your return on investments. The reason being, it's a part of balance sheet, you still have the money, you're not making any money out of it, means you don't make cash out of cash, right? You don't earn anything by keeping inventory, you don't earn anything from the customers who owe you some money, so far as they are within their limits. Even outside limits, you may be very difficult to charge from them, right? So the higher working capital you have, the lower return on your investment your business is going to have. You can estimate it from the two financial ratios that we used to learn in the past: return on fixed assets and return on total assets. So total assets will always be higher, reason being total assets include cash, inventory, receivables, but the return on fixed assets, which is not including the working capital, is usually higher than that, because that's only the production asset, right? In order to maximize your return on total assets, you have to minimize the net working capital. Okay, that's the goal. Now, the objective of working capital, as we have already explained, is to use the working capital is, we have already understood, right? The use of working capital we already understood. Now, the use of objective of working capital management itself is to run the firm with as little as money as it's possible, right? So that's the idea. So the working capital elements as like inventory, so cost of sales can be the most part of the investment. It's the highest part of the investment. So you need to reduce the inventory. You have what are the inventory related ratios to understand if you are managing your working capital very well? Can you tell me an example? So there is a financial ratio that we use to understand if we are managing our inventory well. Inventory turnover ratio. So what that inventory turnover ratio is telling, how many days of inventory you are keeping in your hand, right? So the lower it is, better it is for the business, right? Or the higher time you are turning over your inventory is better for your business. Same goes for receivables. Larger the credit is, higher the investment. So we also have a turnover ratio for understanding the receivables, or understanding how many days of outstanding credit you are allowing. Normally companies set up the policies to control this, right? In this module we are going to learn what are those ratios. Now you have cash. You need cash always for day-to-day expenses, for emergencies, for your float, to pay money in advance and everything like that. Then you have payables, which is helping you to reduce your investment basically, right? And accruals, of course. So the objective of managing the inventory is that if you have high level of inventory, your benefits are that your customers are happy because you always have inventory to sell, right? You have lesser production delays because you always have something on hand. But the problem is that it has a high finance cost, high storage cost. There is always a shrinkage, theft, obsolescence. Obsolescence means that the maybe is not in fashion anymore, right? Low level of inventory will create risk of shortages, because if you don't have enough inventory and your production get delayed, you have nothing to sell. Dissatisfied customer, delay in services, so that creates the risk. But the benefit of this is to have low finance cost, because you're not investing much, and there's not much risk on obsolescence. Means even if something go out of fashion, or changing the brand, changing the logo, your risk is very less compared to if you have a high inventory. So the idea here is to balance the inventory. So there are certain methods which we are going to learn what are the to optimize to usage. So you have to make sure that you don't have shortages, there is no delay in the production and delay in the delivery of and the services, right? But still manage with the lower finance cost and also the lower risk of obsolescence. Then the cash, again, high risk involves the high level of cash, increase the finance cost, increase the risk of storage, increase the insurance premium, increase the risk of getting it stolen, right? And but the benefit is that you always will be able to pay anything. You will be able to handle your emergencies all the time. Like for example, now banks are closed. The company who maintained high cash level, they are now making money, right? They are saying, if you want cash, you take it from me and pay me 5% or 10%. So that kind of business is also happening in the market. But if you have low cash, you have a risk. You don't have the ability to pay any emergency. You have increasing the transaction risk. You have less uncertainty. You have more uncertainty in your business because you don't have cash. But it helps to reduce the finance cost. That's the only thing. There are ways, even if you keep a cash like liquid basis, there are ways to maximize the return. So you invest into the short-term instruments to continue to make some money, right? And then you have account receivable. The other aspect of account receivable is that the benefit is that customers are happy, right? They don't need to pay, or they can pay slowly. So it will increase the sales level, but then the risk is that it will increase also the risk of defaults. Anybody go out of business, you will not be able to collect the money. High collection cost, right? High level of the people that you need to hire to maintain high level of account receivable. You need more people for invoicing. You need more people for collecting. You need more people for accounting for it. But low level of account receivable, again, reduce the financing cost, reduce the risk of bad debt, reduce the collection cost, but increase the level of unhappiness among the customer, that they have to pay, right, faster. And if your competitor is offering a credit, you are not offering a credit, and there's not much of difference in the services, the customer will always go for the one who is giving a credit, even though they may be paying slightly expensive. And all to give the cash, to pay on cash, you may not be able to charge any premium because you are not providing much services. In some industries, providing a credit becomes the unique selling point, right? So you have to look at what are the customer's requirement first before you are deciding to reduce the number of days or other things. So we will be learning that factors later on. Then you have payables. If you have high payables, means that you have get the money from your suppliers. You ask your suppliers to spend for on your account receivable, on your inventory, but then your suppliers will increase the price because you are not paying them on time, right? And they may even stop supplying you altogether in case of emergency needs. So low level means you have happy suppliers, but you are not using any kind of financing. You are paying unnecessary cash. So that becomes the risk of having low account payable levels. That's the objective. So before we go into the working capital management, let's understand about the cash cycle. The cash cycle is built into two parts. One is the operating cycle and one is the cash cycle. So the operating cycle basically is the average length of time between the firm's original purchase of inventory to the selling of the cash, right? And the cash cycle is from the purchase of initial inventory till it receive the cash itself from the output that they have produced. If you look at the graphics, this is a typical timeline of any industry, right? Firm buys the inventory, then it pays for that inventory, and then produce the product, then sell the product, and then it receives its payment. So the operating cycle is from the first point, buy the inventory, until the final point when you receive the money for that particular product. The moment that you started purchasing it until the end of that particular, right? The cash cycle will be reduced by the account payable cycle. So means it's not when you buy the inventory, it's from the day you pay the inventory. So the cash cycle will start from the payment from your inventory or for your cash expenses related with the production, not with the buying of the inventory. But if let's say you're a service company, right? In that case, your operating cycle and cash cycle would be same because you don't have an inventory, but you have expenses. You have salary expenses from the day one, the day you have started the business. And so your operating cycle will be till the customer is able to pay for your services. But and the cash cycle will also be the same because you are always paying the money, right? There may be some small differences between the, well, let's say at the end of the month for the salary, and there's no other major expense. So your cash cycle will be 1 month shorter than the operating cycle in any case. Sometimes you receive an advance, right? So the cash cycle will reduce if you get advances from your customers. So you have to, it's not that you can measure the operating cycle and cash cycle for each and every transaction. You have to look at what is the average, right? In majority, what happens with the cash, with the sales? Is it coming in credit or majority is coming into cash? If it's or advances, right? Then you will be able to determine whether whether your company is in positive operating cycle or negative cash cycle, right? If you follow the formula in terms of the accounting rules, so the cash conversion cycle will be your inventory days, how long you hold your inventory, plus your account receivable days, how long you take to recover the money from your suppliers, minus the account payable days, means the cash that you are not paying to your supplier, right? So that will be there. And the formulas, just to remind you again on the formulas, I think you know the formulas already. So inventory days are inventory divided by average cost of sales. Account receivable days are calculated by account receivable divided by average daily sales. Account payable days are account payable divided by average daily cost of sales. And when you are talking about inventory, account receivable, account payable, we are usually talking about average, monthly averages. So not just like at any given point of time, because that will give you a wrong information. So we are talking about the averages, monthly averages or daily averages, so that you have a better understanding of the inventory holding days. But in the example that we are going to use the problems, it's as of certain date. I mean, not the averages. Okay, so that in real life we use the average. So you have to calculate the average inventory day, average inventory. So how you are going to calculate average inventory? Your inventory will keep on changing on a daily basis by sales and purchase, right? So you will take the daily balance and divide by 30. So you get your monthly averages. If you want to, if you are calculating for the whole year, then you take the average of every single month and then divide by 12. So you will get your annual average. So that's how you will use the formulas in real life. They are basically using their suppliers' money to finance themselves, right? You can see from logic. Their average inventory is $2,000. Account receivable is 16,000. So total their own investment is what? 16 plus 2, 18,000, right? And accounts payable is 35,000. So means they didn't invest anything from their point. They just get their suppliers to supply them first. They produce, right? And then they sell, and they collect the money already and keep it for 60 days before they go and pay to their suppliers. So that's the ideal kind of situation. Right? You are not spending your own money, you are taking the money from your suppliers and using in your business. It's actually a negative cash conversion cycle, which means they receive the cash before they pay for the parts, right? So, but why they are able to do it? Because it's a combination, right? They are not selling on credit, one thing. They sell directly to the consumer and they collect money immediately. Some sales they do through the retailers who pay them later, but it's reduced their in risk. And the size of their bargaining power is quite high. That's why the suppliers are happy to pay them higher credit and wait for the 93 days to settle them, right? Okay, so this is the cash conversion cycle of various companies in the US stock exchange. So you can look at them. It comes from capitaliq.com. I don't know if it's still valid or not, but that's the source of this data. So you can see there are many companies actually who has negative cash conversion cycle. It's brewing company, it's the beverage company, it's the telecom, computer, hardware, surprisingly a pharmaceutical company as well, airlines, internet retail, restaurant, and a grocery store. So these are virtually negative cash conversion cycle. The more on the other company like footwear, manufacturing concerns, home building, luxury goods, certain restaurants, departmental stores, footwear companies, they have positive cash conversion cycle. And the higher luxury cycle they have, the higher cash conversion cycle they will also have. Some of them is because of the inventory days. You can see in the last Brown and Forman distiller, why they are having such a high cash conversion cycle is because of they are not able to sell their inventory that fast, right? Because they may be making certain things which are very slow moving. Home building, definitely you build a house, you let it there for a long time and before you are able to sell. That's why their account receivable day is less, right? Because they may be getting whoever is buying, they may be paying immediately because they won't give the house possession until they get the money, right? So their account receivable days is less, but inventory holding days is high. Luxury goods is usual that their inventory holding days is very, very high, right? It may be good for Louis Vuitton, it may be good for any other big companies, the super ultra luxury brands, where it's very difficult to sell. Basically their original investment is only in the fixed assets. They may be in this position after a very long period of time, right? Nobody is gonna give you money for like 6 months and forget about it, right? In the beginning their cash conversion cycle may be higher, but because of the lesser account payable days, but when they get into the power of position, when they are able to command their rates, it becomes a norm for them to pay later, right? So that's why their cash conversion cycle is negative. So yeah, you are right. The one way to manage the cash conversion cycle is to pay your suppliers late if you are in a position to do that. without affecting your prices and your ability to purchase. The other factor would be to reduce the inventory days, right? You will see some of the inventory days are very, very high. Nike footwear has 90 days before the one shoe is sold. It takes 90 days, right, from the date of production, the starting of production to the consumer. It takes 90 days. So gas is 76 days to sell. Because of the inventory they have to keep in their pipelines, in their storage, right? Otherwise they will be running out of the gas. Certain areas you have to keep a high inventory because you cannot afford to be out of the stock, right? But certain areas you can manage. So for example, a pharmaceutical company, here there are one pharmaceutical company which is paying their creditors also very late. They maintain the inventory on credit, right, even though they are collecting later. So two restaurants there, one Starbucks and one is the another store, the Kroger, the Mexican Grill. One is negative and Starbucks is positive, mainly because of the inventory that they have and the credit that they have, right? So that's the different business models will have different cash conversion cycles. So you want to adjust your cash conversion cycle, you need to understand your business model, how and why your customers are paying you late. Can you make it faster? Can you adjust your inventories? Can you pay your suppliers late? So that's the three questions that you have to ask in order to optimize your cash conversion cycle. So let's understand the last topic on this overview first. So how the firm value is determined by the working capital. Is there any relationship between working capital and the firm value? As I explained you in the previous module where we were doing the capital budgeting, and there was a line called we were calculating the free cash flows, right? We were trying to adjust the working capital change, right? So any reduction in working capital requirement will increase your free cash flows. That means your income, your ability to generate more free cash flows will increase, and ultimately the firm value will increase because of the discounting factor, right? So let's look at this example. This is the projected income and the free cash flows next year to a company in thousands. So there is a net income, then there is a depreciation, capital expenditure, and then minus the increase in working capital, right? So that way is we are getting a free cash flow of $19,000. Now the problem is they expect that capital expenditure and depreciation will continue to offset each other. The depreciation and the capital, because they are same amount, and the both income and working capital will continue to grow at 4%. If their cost of capital is 12%, and they are planning to reduce their working capital by 20% by managing its working capital more efficiently, what would be the effect on their value? Normally there will be an increase in the working capital by 4% every year at a usual, if they don't do anything. So if they don't do anything, then the net income will grow at 4%. The depreciation and capital expenditure will offset itself. Working capital will also increase at 4%, right? i.e. the free cash flow, overall free cash flow 19,000 will continue to grow at 4%. That's the meaning. So how will you value the firm? So first thing is the value of the firm. So 19,000 divided by, what is the formula? Free cash flow divided by R minus G, right? So 19,000 divided by 12 minus 4. So 8%. Now the another scenario that this Emerald City is saying, that what if we are able to save 20% of the working capital requirement, working capital. Now the 20% saving on 1,000, and then it will increase at 4%, right? The savings will also increase at 4%. So means that you are saving around $200 every year on this, correct? So means your working capital would reduce from 100,000, a million, 1,000 to 800, and that's how it will be. So you need to use the formula cash flow divided by R minus G. So your actual value at this point of time is this, right? 19,000 divided by R minus G. And if they manage their working capital more efficiently, their value will, these all remain same except the working capital. So their value will increase from 237 million to 240 million. So the net impact will be $3.5 million. That's their firm value will increase. So if you say that how much I need to invest on an inventory management system that will help me to reduce the inventory holding days, or that how much I should invest in a collection system that will help me to reduce my account AR holding days, that's the value. So you can see how much you will be saving, what is your cost of capital, and then it will give you the value that over the life of the company how much value you will increase, and based on that you can estimate is my investment worth or not, right? The shortcut to calculate this is because it's a 20% saving on the working capital management, rest everything is same. You could have just divide 200 by 8%, so that you will get the similar result. So working capital need in different type of firms. So how do we estimate the working capital needs of the firm and how do we manage them? That's another question that we need to understand. So there are two type of companies, right? One is a stable company which has stable operations continuing at a very small pace, or maybe 10% increase or 15% increase, like a constant, right? For them, they have a fixed asset and they have their permanent working capital. Permanent working capital means the total amount is not going to change much. So if you see their balance sheet, their total of cash, inventory and payables would remain similar, right? Within a similar range, not fluctuate like up and down. And then there are seasonal companies. Now seasonal companies means those are like hotels. They are seasonal, right? They in the low season they have very less business, so they have less requirement of the working capital. But in high season they have super high business and they may require high cost of capital because of the higher business volume. Then there are certain other companies which are either closed or having very low business volume in the low season, or cyclic businesses, manufacturing concerns or the agriculture concerns, which are growing the seasonal products, right? So those things, during the low season they will need maybe higher working capital, some for until they get the cash, right? Because they need to keep on investing into the business. When the high season comes, they have enough cash, so they don't need that much of working capital. So it depends on the size of the company and also the nature of their business. The working capital requirement can be different in different phases of the business, different years, different months of the year. But in any case, you may need some minimum working capital. Let's say you may need certain minimum cash expenses to continue. You may not have too much money to be invested on the inventory or in the debtors, right? But you may still need some minimum cash. So you can divide the total requirement of the working capital into, in a stable company is going to be stable. This is the total requirement of the investment. Out of that, some part is the fixed asset, some part is the working capital. And then there are seasonal company where they say there is a fixed asset, there is a permanent working capital. There is another type of working capital which is temporary, which is need only in certain times, whether there is a high spike of business, whether there is a no business, right? So you will have a different type of companies. So the working capital finance policies are also aligned with the different type of companies that they have. There are certain companies, their policies which says there is a fixed policy, means I will give you a fixed money. Even if there is a fluctuation, you can invest the extra money that you have into marketable securities, or I will give you the lower end of your working capital. So whenever you need to borrow. So there are two type of policies. One is F, means the full. I will give you the full value of your working capital requirement, the highest amount. That's typically a conservative method of providing the working capital. So you take a loan up to the or long-term financing or equity financing or debt financing to the maximum amount of your working capital, your fixed amount plus your working capital, so that you don't have to borrow money from anywhere, right? But extra money, whenever you don't need it, you can deposit into your marketable securities or any other where the company has allowed you. Then the other type of policy is called the restrictive policy, where they provide the lower end minimum amount. After that, the extra amount you have to get the financing for short-term based financing, right? So that's the requirement. But there is another way, which is a middle way, right? From the, not on the total, not on the top, not on the bottom, you provide an average long-term financing. So when you have extra, you deposit into marketable securities. When you have short, you take loan, short-term loans. So that's the difference between the flexible policy, the highest, the restrictive policy, and a compromised policy. Well, I'll explain you the last one because that's crux of the all the discussion. Basically, there are three type of policies that you can follow for your working capital requirements or your investment requirements. So your investment has two parts. One is fixed asset, fixed investment like capital investment. One is your day to day, like your inventory, your accounts payable, your cash requirements, right? If it's a stable company, you just have to provide one amount and that's it, done. You don't have to provide any time else because there is no extra money, there is no lower money, correct? But if it's a seasonal company where you may need someday, you may need $100,000, another month you may need only 50,000, and another month you may need only 20,000, right? So the companies have two choices. One is the flexible policy, means they will provide you the 100,000 to keep. That okay, your maximum amount you need is 100,000 for your inventory, for your working capital, cash, you keep 100,000. So but you will have extra, right? When you don't need it, you have extra money lying in your bank account. So what you are going to do with it? Normally you try to find and deposit into your saving account so that you can earn some interest, right? Or government bond, or give it to your friend or something. And there's another policy is that okay, you need minimum 20,000. So I give you 20,000 so that maximum of your months are meet. But the extra amount, whenever you need, you just borrow money from the bank to meet those immediate requirements whenever you need, right? So that's another way. The third way, which is a compromise policy, it says you take an average. One month you need 100, another month you need 50, another month you need 20. Okay, take an average, 170 divide by 3, that becomes about 60,000, right? So you provide 60,000 as a normal. So when you need only 20, you have extra 40. So you can deposit that into a bank. But when you need 100, you are short by 40. That time you take it out, either take it from the bank or take it from the other financing, wherever you are taking, but take short-term finance. So that's the idea of working capital management. But you need to understand what is your working capital requirements. Okay, so here is an example. So in this case, there is a net income, there is a depreciation, there is an increase in the working capital. Total free cash flow is 80,000. Again, they are saying that their working capital is grow by 6%. Their cost of capital is 8%. If they try to manage their working capital by 10%, how much would be the impact on the value of the company? So you can do the same thing. Basically, you are just saying you are going to save 10% of 80,000, right? So 40,000. So it's 4,000 that you are going to save every year. So you can do the cash flow. 4,000 divided by 0.02, that will be increased to $200 million that you are going to increase in the value. So that's how it's calculated. Okay, so there are three components of working capital. One is three main components, right? Four main components. One is account receivable, inventory, cash, and accounts payable. So let's look at accounts payable first. The trade credit, as we say, is the trade credit is both ways. Taking trade credit and giving trade credit. Yeah, either you are taking money or you are giving money. Both are called credits. So the credit that a firm extend to its customer and the credit that the firm is taking from their customers. So normally there are certain trade credit terms that are used. Example 210 net 30. Do you know what is and anybody know what is the meaning of this? It's a US term. They say 210 means 2% discount if you pay within 10 days. Otherwise, pay full in 30 days. Means we are giving them a credit until 10 day anyway, right? But if they pay within 10 days, we give them 2% discount. If they don't pay in 10 days, then they have to pay the full amount up to within the 30 days. That's the meaning of this one. So in discount, there is a cash discount, 2%, discount period 10 days, and the credit period is 30 days. So that's the example. There is a cost of the annual credit, right? Now this 2% that you gave a discount, there is an annual cost of it, correct? Remember the EAR formula, equalized annual rate. So your firm purchased goods from its supplier on a credit term of 115 net 40, right? So what is the annual cost to your firm if you choose not to take the advantage of trade discount offered? You say you don't want to take discount. You don't want a 1% discount. You will pay in 40 days. So what is the cost of it? So using $100 purchase as an example, let's say you get 1% discount, you pay within 15 days, or you pay full amount in 40 days. So means you are saving $1 for 25 days. Either you pay $99 in 15 days or you pay $100 in 40 days. So basically you are getting a $1 credit for 25 days. So the difference is 25 days, means you need to calculate the equalized annual interest rate based on 25-day interest period. Okay. So the formula for EAR was 1 over 99. So that's a 1.01% because you are giving 1% interest, right? On $99. So basically the interest rate is 1.01 for 30 days. The interest for 30 days is 1%, 1.01%, and there are 14 periods of similar cycle. You are saving $1 only for 25 days, right? So basically you are having 14 cycles like this in a year. So your equalized annual rate will be 1, EAR was what? 1 plus rate to the power minus 1. So it's 15.8%. So basically what the meaning of this is, if you really need to take the full credit, you need to make sure that you are able to borrow money. You are able to earn 15%. Otherwise, no, you don't. You need to take the advantage, right? So if you are able to borrow at lower than 15% from the bank, then what you should do? You should borrow money, right? And pay $99, because your cost of credit that you are paying, your annual interest rate you are paying is $15.8 or 15.8% to your supplier. So basically what you need is, you need to calculate an equalized annual rate and see is it more or less than your borrowing cost. If let's say you say no, I better off keep money in my bank because I'm getting more interest, right? Then I will keep money and then I will pay later because I can get more money by keeping the $99 for 25 days. So the cost of keeping $99 for, $1 for 25 days is 15.8%. Something called collection float. It happens normally when you are not actually able to get the digital transfers. So there is always a collection float, means how much money is lying on the transit, right? So there's for example, a customer mail you a check when you are getting a money by check. Then the firm receives the check, means it's a processing float, then they deposit into the bank, then the money credited into their account. So the more time it takes, higher is the cashier collection float, and because you are not able to use that money for that period of time, there is a loss, right? The idea is to reduce the collection float. Nowadays companies are doing instant transactions, right? They use the mobile wallet, they use the internet transaction to pay. The sum of the float is still pending in the while that you transfer the money from here to another country. There is a SWIFT. It takes some time, right? So that's the cost of that another guy to because the money is going from your bank already and has not reached the customer account between a certain gap in the period. So the customer may want to see how he can the supplier may want to see how he can reduce that time. by doing alternative methods of payment. So there is a receivable management. How do we manage the account receivable? In managing the account receivable is to establish a credit policy. A credit policy has 3 steps. One is you need to establish the credit standards. Who is going to get the credit? How they are going to apply the credit? How you are going to evaluate whether they are worthy of credit or not, right? And how much is your standard? What is the maximum amount of credit you will give? How long you will be doing the credit, right? That is one step. The second step is the terms. When they have to pay, are you going to give any discount to them or cash discount to pay early? And then the last is the collection policy. Who will collect, how you will collect, how often you will follow up, and those kind of things. So the credit policy has 3 different parts. One is establishing the standard, one is establishing the credit terms, and then finally the collection. What will you do with the defaults? Are you going to charge any interest, right? So those kind of things are covered in the credit policy. Then there is a 5C of credit, means when you are establishing the credit standard, when you are establishing the credibility of the company, there are normally 5 C's of credit. One is you will look for the character of the company. What are their values? What is their standing? What is their capacity? Do they have enough assets? Do they have enough cash? Do they have a factory? Do they have fixed assets? Do they have cars? Do they have house? Same like a bank, they will assess your earning capacity, your capacity to pay the interest, repay the money, how much money you actually have invested into your business, right? The company will see before they give the credit to another person is what is their capital. Maybe the total investment into their own business is maybe only, let's say, $2,000, and so you cannot give them a $50,000 credit, no, right? So you will have to establish their character, whether they have been paying their money in the past, whether they are paying their bills in the past on time, their capacity to pay, their capital investment, are they doing any collateral, are they able to give anything to collateralize, any guarantee, any bank guarantee, and what are the conditions, right? So these are the 5C in the credit when you are evaluating any credit application for the company to establish credit of any person. Managing the AR is pretty much like a common sense, right? The first thing you need definitely is the 3-step. One is the establish the credit policy of your company and select the customers who are worthy of credit, right? Then second is send the invoice on time. That is the most important aspect. That is the second important aspect, sending the bill on time, right? And then reminding them and collection. So these are the 4 steps in receivables management. But there is another aspect of the credit policy is that if you want to change the credit policy, what would be the impact? How will you evaluate that? So for that, there is an example, right? So the example is, let's say the company is selling the product with 1% discount to customer who pay immediately or a full price within 30 days. So means basically you are saying that if you buy now, you get a cash price, right? Otherwise, you can buy at a credit which is 1% higher, and you have to pay within 30 days. So half of their customers take the credit and half of their customers pay immediately, right? Now, if you are considering hey, I want to drop the discount, means I don't want to give 1% discount anymore. I want everybody to pay me 30 days later. So what will happen? So now you are saying that if you do, you expect to lose some of your customers who may be willing to pay only a discounted price, but the rest will simply switch, no problem. And after evaluation, after doing an estimate or survey or something, you say there will be only 20 units smaller. Now you are able to sell 500 units. You will be losing customers equal to 20 units. So the rest of 480 will continue to buy from you, right? So if the variable cost is $60 and the selling price is 100, and your required rate of return is 1% per month, should you switch your policy? So that's the way of evaluating the credit policy. So now let's evaluate it. So the plan is, the first you need to calculate the net present value. So it costs you $30,000 to make 500 units, and you will receive half of them immediately, right? $99 per unit. So which you means you get 44,000 something. Another half comes at the 30 days, correct? At that point you start again, and then you want the next batch of the product, so you have to pay immediately the money for the next batch. So if you think like this, you can make a cash flow every 30-day period, so every month, right? So now you pay the next, you pay the produce first, so you pay you or you can say, let's say you buy you are buying from an outside supplier at cash, so you are paying $30,000 now, and you are selling it now, you get half price, so you get $24,000. So your investment at this point of time is only $5,250. At the end of 30 days you are getting 25,000, but you are again saying that you will be paying 30,000 for the 500 units, and half of them you will sell immediately, and you get 250 units, so you get 24,000. So basically you are saying you will be able to get around $19,750 at the end of 30 days. That is your existing. But if you change the policy to 30-day advance, means you need to pay $60 now for your investment. 480 into $60 becomes 28,800, and everybody will pay you at the end of the day, which is 48,000, but you need to pay the next one. So you are gonna make another $19,200 every after 30 days, but you have to pay 28,000 immediately because you are not getting any money, right? So the incremental ones, so the one way is to calculate the NPV of both, or calculate the incremental amount, right? So you have to both the choices. So NPV of the current one is 1,900, and the NPV of the second one is 1.891. So the way to calculate is also simple, right? The cash flow divided by the rate, because you will have this every month, the same cycle, assuming every month we are able to sell only 500 units or only 480 units. So the cash flow will remain the same every month. That's why we are using the perpetuity formula here. So the NPV of the switch is, your value at the moment is 1.969, and your value in the new policy will be 1.891, which is lower. The other way to do was to get only the incremental value. So your incremental investment is $23,000, and your incremental benefit is only $600. So that was the another way of calculating. So you just only get the incremental 23, and then here is 19,700, and here is 19,200. So is the loss, right? So basically the answer is you should not make the switch, because you are losing too many customers, and the value of your benefits is going to be less. How many customers you should get in order to make no loss, no profit situation? So means how many more units they should have been able to sell with this. That's only a theoretical situation. In real life, if you decide that you want to give a credit, sales may increase, right? Or maybe even the more customer will lose because they want to get more discount. So you have to do that estimate by talking to your customers. So the managing the account receivable days is one way is to monitor it, right? So you have set up the account receivable policy, you set the invoice, you send the collection reminders. So the fourth aspect of the account receivable management is to monitor the account receivable days. How many days are accounts payable? One was to look at the account receivable number of days, the average number of days it takes the firm to collect. That is your AR turnover ratio, right? And the another is aging schedule. So here is an example of aging schedule, like 0 to 1 to 15 days. How many accounts, how many percentage of accounts are pending, and also in the similar way you can do the dollars in terms of the dollar value. How much money is lying in up to 15 days, up to 30 days, up to 45 days, up to 60 days, or more than 60 days. So how many times you will send a reminder, and if they are still not paying, what you are going to do legally or by selling it to some other. So there is another way to do it, is to sell to somebody else. For example, there are AR factor companies who will say, okay, they will be happy to collect it. So but they will ask for discount, right? So the only thing you have to again look at it, if you wanna sell your AR to a factoring company, how much is your equalized annual rate that of the discount value that they are charging? So if you, let's say you are giving a credit of 30 days, you sell now, so basically you are paying 2% for 30 days, right? So what is your actual annualized rate, and can you borrow money lower than that? So then you will know the answer, you should sell it or not. So here's an example. They normally financial training system is billing its accounts on term 310 net 30. The account receivable include 100,000 that has been outstanding for 10 or fewer days, 300 for 11 to 30 days, 100,000 for 31 to 40 days, 200,000 for 41 to 50 days. Wow, every 10 days their amount is keep on increasing. So you just have to prepare the schedule, which is like this. So simpler, just in the total number of amount in outstanding, total amount is 532,000, and the over 60 days is certain percentage. So normally in the AR, depending on the credit policy of the company, let's say if they are allowing only 30 days, so anything more than 30 days, 31 to 40, 41 to 50, 51 to 60 is potentially a problem, right? So they have to focus on that. If they are allowing 60 days, then only the 2000 will be a problem. The accounting side, they have to also have a provision for bad debt. So normally depending on the company policy again, if they see the more than 60 days is a threat, then the entire amount of more than 60 days will become doubtful, and they will make it a provision to write off the amount immediately, unless you can prove that they will pay. Like for example, now if let's say the hospitality industry, because of the virus, many travel agents are closed. We still owe them, we still owe some our supplier, but we are gonna continue, right? But the travel agents may shut down their business. At the moment they just shut down the office, so we still have some hope, but there may be some of them, they may never start their business again, so we will lose that amount of money. The second thing in the same similar fashion is the payables management. So basically for payables, you don't have to establish the credit policy, because credit policy will be established by your supplier, right? So you just have two things here to do in payables management. One is to monitor when you have to pay and make sure you're not paying earlier than that, unless you get a discount, right? And then again, how much earlier you are paying and how much discount you are getting, you have to calculate the annualized interest rate, equivalent annualized rate of that discount over the annual period, and to see is it worthwhile for you to pay now or later. So it depends on you are able to borrow money at lower than that rate or not. So here is a problem related with the account receivable. The Route company has an average accounts payable of $250,000. The average daily cost of sale is 14,000, and it received term is 215.40 from its supplier. Route choose to forego the discount. Is the firm managing its accounts payable well? So what does the problem ask? It's saying that if you pay within 15 days, you get 2% discount. Otherwise, you pay in 40 days. And Route saying that, okay, I will forego the discount, I will not pay. But is it right for them to do? Are they traditionally paying in 40 days or not? To look at that, we need to look at how much is their accounts payable pending days, right? And the formula was accounts payable divided by average daily cost of sale. So traditionally they are paying in 17 days, and their discount is 2% in 15 days. So means they are not taking the advantage of discount. In other, they are taking advantage of 40 days. So they are also not utilizing the amount for 40 days, right? So they are paying late by 2 days, but early by another 25 days or 23 days, correct? Too early. It means they are not managing their accounts payable well. They should wait for the payment until either 48 day or you pay within 15 days. So either you take the discount or you pay on your credit term. So you can always check what is my average accounts payable day and see is your company is your finance guys taking an advantage of the entire credit period or not, or they are paying too late, or they are paying too early. If the accounts payable department is structured, they will establish the payment dates for every invoice and see whichever are dues they will pay after the proper due dates. But if it's not structured, they may just pay based on the demand from the supplier, right? The supplier, even though they may allow 30 days, After 10 days, supplier may follow up. If the accounts department is not really on top of it, they may just pay. Okay, never mind. We have money, let's pay it. Many companies nowadays, what they are saying is either we pay once in a month or twice a month, and they will pay the previous month invoice, right? So let's say the invoice came in January and the payment date is February. Some companies, they do like if the credit is 30 days. So let's say an invoice is coming on January 1st. So 30-day means they should pay by 1st of February. But they don't have that facility to pay, right? So they say, okay, we will pay on 15th. But the invoice which is coming on 30th of January is past only 15 days. So if you pay that amount also, then means you are paying 15 days early. But the other contention is that on the invoice that they receive on 1st of January, they are taking an advantage of 40 days or 45 days, right? So maybe they say, okay, average, and we pay on 15 or 20th. So that also happens, but in that case, they have to see also what are the periods at which they are actually getting the more invoices. Is it the beginning of the month or is the ending of the month? If ending of the month is most, then they are paying early. If beginning of the month is most, then they are okay, right? And sometimes there are cash discounts. Like if let's say you have extra cash now, right? So you can always go and approach the suppliers that, hey, if I pay you now, will you give me 1% or 2% discount, cash discount? Certain suppliers, they agree. Sometimes finance department is not taking the advantage. That comes down to the cash management, how effectively you are managing your weekly or monthly cash.